Accounting equation and Excel, adjusting entry for loan payable, breaking out the short-term and long-term portion of the loan. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. Here we are in Excel. First, a word from our sponsor. Yeah, actually, we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever, because our merchandise is better than their stupid stuff anyways. Like our Accounting Rocks product line. If you're not crunching chords using Excel, you're doing it wrong. A must-have product, because the fact, as everyone knows, of accounting being one of the highest forms of artistic expression means accountants have a requirement, the obligation, a duty to share the tools necessary to properly channel the creative muse. And the muse, she rarely speaks more clearly than through the beautiful symmetry of spreadsheets. So get the shirt, because the creative muse, she could use a new pair of shoes. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. If you don't have access to this workbook, that's okay, because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook, though, there are 5 tabs down below. The example tab, in essence, the answer key, month 1, first month of operations, month 2, second month of operations. The practice tab, having pre-formatted cells, so you can practice the practice problem with less Excel formatting. The ADJ tab, the one we will be working in, is where we started with a blank worksheet, but are basically working within a template at this time. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we'll be doing this time. Remembering we're basically building our bookkeeping system using the accounting equation as, in essence, our trial balance from which we will construct our major financial statement reports, balance sheet, income statement, statement of equity. We have entered the first month of data in the month 1 tab, closed it out, entering the second month of data input in the month 2 tab, and then we created our adjusting worksheet, which is where we are working now, keeping separate in our mind the objectives and the process of the bookkeeping or accounting process versus the adjusting process. The adjusting process often being done by a different person, but not always, but possibly also in another software such as a QuickBooks or Excel, I should say. So even if the bookkeeping was done in a QuickBooks or a Xero software, for example, we might then export that information to something like an Excel in order to have a more transparent worksheet for the adjusting entry process, and then possibly enter that information back into the QuickBooks system. Remembering our objective for the adjusting entries is to make things as correct as possible according to the accounting basis being used, oftentimes the accrual basis, but sometimes just the tax basis, if we're doing tax preparation at the end of the year, for example. So this time we need to do an adjusting entry for the loan payable. So we had 2 loans on the book. So also just remember that we're doing the adjusting entries as of the cutoff date, which in our case is the end of 2 months. Oftentimes you might do it monthly, quarterly, or yearly. We're doing it for 2 months ended because that's how much data we have entered thus far. So we want to make our statements correct. We're thinking on an accrual basis for the 2 months ended February 28 or 29, depending on the year that you're in. But we're going to say 2/28. All right. So we're going to go into the liabilities. Now, what we had is the 2 loans. Few things that we want to keep in mind whenever we're thinking about loans. Remembering we have to keep the bookkeeping objectives different than the financial statement reporting objectives. From the accounting or bookkeeping side, what we want to do is make it as easy as possible to record the loan payments and the loan itself, as well as automate the process to the extent that we can, possibly with the help and the use of the bank feeds. So the easiest way often to do that is to record the loan into a separate account per loan so that whenever I make the payments, I can easily tie out the amortization tables to the loan payments per loan. So that first thing could be useful. Secondly, we don't typically want to break out between short-term and long-term every time we enter a transaction into the accounting system, because that would cause us to do another journal entry and less automating of the process. Therefore, we once again would like one account per loan, not a short-term and long-term, not consolidating all of the loans into one single account, but one account per loan would be the easiest thing to do oftentimes. From an adjusting entry process, however, what we typically want to see on the balance sheet is all of the short-term portions of the loans in one account called loan payable, and not see all the detail of different loans, right? And then we want to have one account, which will typically be the long-term loan payable, and then possibly have notes to the financial statements, which would include the information on like the amortization table, telling us all the different loans which maybe compile up to the short-term portion and the long-term portion of the loan. If you're using something like software, like a QuickBooks, for example, and you had these two loans, you might be able to use sub-accounts to achieve both of those goals to some extent, so that we can have a different loan account per loan, but have them collapse together to have one loan account for external reporting if we needed to do that. But even then, you'd still have to break out the short-term and long-term portion. Now note that if you recorded the loans properly as we go, and all your loan balances tie out, and you recorded the proper amount of interest expense, if you're a small business just reporting a Schedule C, for example, that you might not need to break out the short-term and long-term portion of the loan at the end of the year, because the reporting for taxes on a Schedule C doesn't have a balance sheet. So because there would be no income statement component of that journal entry, you might not need it for taxes in that case. But if you were doing external reporting on an accrual basis for the bank to get a loan or something like that, or for investor needs, or for your own internal decision making, then technically you should be breaking out the short-term and long-term to see the amount of the loan that's going to be due within a year versus the amount of the loan that's going to be extending beyond a year. So what we're going to do now is break out between the short-term portion and long-term portion of the loan, noting this transaction, once again, isn't really a classic adjusting entry in that it's going to have two accounts that are both balance sheet accounts, more specifically, both liability accounts. One's just going to be a short-term liability versus a long-term liability account. Classical adjusting entries typically are going to have a timing difference, meaning they're going to have an income statement account, at least one, that will be impacted. So this is an adjusting entry in that we can plan for it to be the case. We can plan for the bookkeeping process to do what they need to do. The adjusting process does an adjusting entry, but it's not exactly like, from a very strict standpoint, the adjusting entry that you'll see in book problems all the time or often, because those often are defined as something that has a timing difference basically to them typically. Okay, let's go back to the adjusting entry. Now, one more thing I just want to point out as we do this is that you might want to take it a step further and try to automate your accounting department even more so. And with the loan payments, the problem is because there's an interest and principal breakout, it messes up the automation of the bank feeds. So you could go a step further and say, look, I'm just going to record all of the transactions as decreases to the loan balance so I can automate it with the bank feeds and then shore up the balance at the end of the year. So I'll keep that in mind. We'll talk about that more kind of as we go here. All right, so what we have over here is we've got the two loans, and we have the amortization tables for the two loans on the right. So I'm going to go all the way to the top up top. I'm going to scroll all the way to the right to where until at least I find the amortization tables. So let's go to the right. So here we are. So I'm on column EP. This was our amortization table for our longer loan that we put on the books for $72,000. All right, so we're going to imagine that 2 payments have passed, and so this is the balance that is currently on the books right now. So that's 69,878. If I look at over here, I'm scrolling back over loan number 2, 69,878. That's the amount on the books according to our amortization table. And so our amortization table ties out as of this point in time. Now note, this entire amortization table we created when we did the data input into the system, and is something that sometimes the bank might provide you with, but they might not, because they're not often or not required to, possibly, because you have all the information in order to create one. In other words, if you've got the loan balance, the payment, and the interest, and the period, then you can create your own amortization table. You can do that in Excel. You can also use software to do it. I like doing it in Excel and then using the software as a double check. And you could just look up in a search online for loan amortization calculator, and you'll find different items out there. I like having it in Excel though, because now I can break out the short-term and long-term portion of the loan. So that's what we'll do this time. So I'm gonna make another couple columns. So I'm gonna go to column EW, go to the right to like EZ, right click and insert, inserting a couple columns or a few columns. I'll make them a little bit larger. All right. So now notice what is happening with our problem here. Whenever I make a loan payment in the accounting system, the dollar amount remains the same, because that's how most often loans are made, making a loan that's an installment loan, similar to what you might be familiar with a mortgage. However, some loans for business loans might not be structured that way, but let's just say that's the standard structure for like a car loan and many types of loans. They want to make the payment the same because it's easy to budget for a payment if it's the same on a cashed basis. The problem is that the interest and principal are going to differ each time. So you see that that's a problem when I try to automate my payments using the bank feeds. The dollar amount will be the same, but I can't automate it because this breakout will be different, and I have to look at the amortization table every time in order to properly break out the interest and principal. Now, one way that you can deal with that is say, hey, look, I'm not even going to deal with that. I'm just going to say I make the payment. I'm going to lower the loan balance directly, ignoring the interest. And then I'm just going to, at the end of the year, fix it by printing out the amortization table and doing the proper adjusting entry, making the loan balance correct as of the end of the period and putting in the interest. You see what that does is it allows us to achieve the two objectives, maximizing efficiency on the bookkeeping side by just recording everything in essence on a cash-based system so we can automate it with the bank feeds, and then allowing the adjusting department to just do a periodic year-end adjustment, properly recording the loan balance according to the amortization schedule, properly recording the expense, and if needed, as we'll do here, properly breaking out the short-term and long-term portion of the loan. So that's just something to keep in mind that might be worth doing. To do that, make sure that you understand what's going on the bookkeeping side, and you have a good tax preparer at the end of the year, which can make the amortization tables and or do the proper adjusting entry to break out the expenses. Or possibly you do both things. That would make sense too, because it still allows you to kind of automate things during the year. All right, one other thing just to point out, that oftentimes you'll have a loan on the books that's going to be tied to equipment that you're purchasing. And sometimes there's going to be trade-ins of equipment or something like that if you're in a construction company, for example. And that makes the transaction somewhat complex. So oftentimes you might communicate with the CPA firm whenever you put a new loan on the books, which is possibly using equipment as the collateral to try to get the loan on the books correctly. However, again, you might just say, I'm not going to do that. I'm going to just stay in a cash-based system. I'm going to record the new equipment that I put on the books just as the down payment for whatever I paid for the equipment. And then I'm just not even going to record the loan on the books until I make payments. And then I'll make payments from the loans on the books. And then at the end of the year, I'm going to give to my CPA firm or my tax preparer the loan documentation, the equipment purchase documentation, and the trade-in or whatever that might be involved with it, and let them not only break out the short-term and long-term portion of the loan, not only adjust the calculation for the interest, but also properly enter the transaction to record the loan and the equipment. And that's often useful to do because, again, it lets you be on a cash-based system, and it lets you automate the system. And oftentimes, if it's a complex transaction, the CPA firm is going to need the depreciation schedules before they can even really properly record the transaction. And therefore, it might even be easier to do at the end of the year. Otherwise, they're going to have to reverse what you did and then fix it anyways, right? So sometimes that's just the easiest thing to do. Just say, I'm just going to record everything on a cash-based system, but make sure I have the documentation for all loans, all purchases, all trade-ins, so that I can then give that information to the CPA firm, and they can make the proper adjustment for the recording of the loan, recording of the equipment, breaking out the equipment on the sub-schedules, breaking out the short-term and long-term portion of the loan, and doing the interest. Okay, that said, what we did, we put the loan on the books properly, and then we recorded our payments properly, breaking out the interest and principal, tying out the balance to what's on our general ledger each transaction. So now all we have to do on the adjusting side of things is break out the short-term and long-term portion of the loan. How do we do that? All right, well, if there's going to be 12 payments from here, short-term means that it's going to be due within 12 payments. So if I just count up 12 payments, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, that would be a year from now. We would be down here. I'll make this one like green or something. So after a year of making payments, our balance is going to be here. So then the question is, well, what are my payments for that year? You might say, well, I should have the 1359 times 12, about 16. I'm kind of messed up because of 16,308, because that would be 12 payments, 16,308 about. But that's not exactly correct. And the reason is because the interest has not yet been incurred. So although current portion of the loan, we're going to pay 16,308, actually the interest portion is rent, and we're not going to include that. You might say, well, why don't I include that? Because I know I have to pay that. So shouldn't that be the liability? And the answer is no, because that would be like recording the rent that you owe because you have a contractual obligation to pay a 5-year rental contract before you used the building to incur the rent. So although you have a legal obligation to pay it in the future, you haven't yet consumed the rental property, and therefore it shouldn't be on the books yet as a liability at this point in time. In other words, if they kick you out of the building, you wouldn't have to pay it because they broke their end of the contract, right? So that means what we should be doing is summing up just the loan reduction. This is the principal portion of the payments. So there's the principal portion of the payment. So that would be the short-term payments. And if I'm at 56,770, then I'm going to say this is the total loan after 12 months minus the short-term portion gives me the long-term portion of the 43661. So this is going to be short-term, long-term, and if I add those two together, I come up to 56,770. I'm sorry, I messed that up. Long-term is not good. The long-term is going to be this amount after the year. And so if I add those two up, I come out to 68 or 69,878, and that's the amount here, 69,878. Or in other words, if this is the entire loan and I break out the short-term, so I'm going to say the short term is going to be equal to the sum. If I do it this way, might be, you can see it both ways. Here's the principal, loan reduction, just the principal. This then once again, is the short term. So the long term is going to be the total amount of the loan minus the short term, 56,770. That's the 56,770 where we will be after making 12 payments, after we account for the basically the rent expense of the money, the interest that's been calculated. So that's what we need to do. We need to be breaking up between short-term and long-term portion of the loan. All right, so if I go back on over to the left, I can say, let's just jot that down in our journal entry. We're going to say this is going to be on 2/28 as of the cutoff date, because we only had 2 months of data input. We're going to have, this is going to be the ADJ for the loan adjustment. So it's going to be a journal entry type of transaction. We have the long-term portion and then the short-term portion. Let's indent that. Home tab, alignment, indent. And I'm just going to say equals and pull this in from our worksheet. So everything ties out so I can see where it is coming from. I'm going all the way to the right back to that amortization table. And I think the long-term portion was this 56. And the short-term portion is going to be equal to, scrolling all the way back to the amortization table. Otra vez, one more time. Uno vez más, por favor. 13,109. Okay. So then if I go to my loan balance over here, I can say, all right, let's check out what we got. What do we got? So we've got, this loan is the one we're looking at. It's all in the current liabilities section as of now, because that's usually where I group my loans on to start with, in part because all loans will typically have a short-term basis to them, unless they're not installment loans, in which case they might not have a short-term basis to them. But not all loans will have a long-term component. For example, this one is going to be, we're going to pay that off within a year. So there's only a short-term component to that loan. So we don't even have to do anything to that one. So what I'm going to do is I'm going to add another column for the long-term account. I'm going to select this column, which is AE, right-click and insert. And then I'm going to format this a little bit different, because this is going to be the long-term portion. I'll make this a little larger, and I'm going to make this like dark red. So just this bit, let's make this bit dark red so that I can, let's make it light red and then dark, and then the darker text. And let's spell it right if we could. Long term. All right. So current liabilities, long-term liabilities, so what that means. All right, let's put some brackets around this whole thing. So for formatting's sake, and we'll make it a light red again. So light red, black text, borders around it. All right, so there we have it. Let's do it on the top bit too. I have to do it all the way up here. For formatting's sake, man. For formatting's sake, what are you doing? Okay, and then let's also get rid of my borders here. So just to clean this up a bit, let's remove the borders, and then let's put borders around like this whole bit, like to there, and put a border around that whole thing. Let's make it a thick border. And then this bit, let's remove all of these borders. Let's get rid of these borders, and then make the border all the way across, but do a thick border. So what I'm trying to indicate here is all of these are liabilities, but then these are the current liabilities, and these are the long-term, and this one's at 14. Let's bring this up to a font size of 14. All right, so there we have it. All right, and then in long-term liability, we've got the loan payable 1. I'll just say long-term. Loan payable 1. This is the long-term portion. All right. So that's what we're going to do. Okay. So then let's see. Where do I record this? So I'm going to be on this line. So all of it is currently in the short term. I have to break out the long-term portion of it. So I'm going to say this is going to be equal to the long-term bit, 56,770. and I'm going to decrease the full amount, which is here, by that same bit, decreasing this by the 56770. And let's put zeros across the board for formatting's sake. All right, zeros across the board. Notice nothing's happening on the income statement because we actually broke out the interest and principal correctly. Let's do an underline, home tab, font group, underline, and then we'll bring down the balance. Let's make sure that we're in balance thus far. So I'm going to copy this down. Let's put some underlines across here. Home tab, font group, underline. Notice it's not in balance. What happened? Well, if I double click on this, I added cells over here, but I didn't. Now this one isn't included in my formula, so I'm just going to make that included in my formula. And I got to make sure to copy that formula down so it's also included in the balance, but then get rid of the underline down here because that's not where it should be. And then we'll sum this up equals the SUM of the prior balance current activity. And we'll copy that, Control C, Roger, 10-4, copy that. Holding down Shift, go into the right, and then we'll paste this formulas only. And let's do some formatting. Drag this down for formatting's sake. Drag this down for formatting's sake. All right, so now the long-term portion of the loan is at the 56770. That makes sense. And the short-term portion is the 13109. So when I combine these into my financial statements, these two are going to collapse together, which if you were using software like a QuickBooks, you might be able to do once again with sub-accounts, which would collapse these two down to total short-term amount of 18109, which can be supported by the amortization schedules for the two loans. And then we have this bit, which would be just the long-term portion that's going to be due after a year on the financial statements as well. So that's going to be the general idea. Now note, this is a lot uglier for data input, however, from the bookkeeping perspective. Therefore, after we do the reporting on the financial statements, we might enter this into QuickBooks so that you could show the short-term and long-term, possibly generating reports from QuickBooks if you wanted to. Otherwise, you can create it in your Excel worksheet if you're generating your reports from there. But we can do that, but then we have to reverse it as of the first day of the next period. Otherwise, our accounting department isn't going to be able to tie this out, because what's going to happen next time they make the payment, they're going to say, hey, wait a sec, this doesn't match my amortization table. And even if they say, oh, well, if I add those up, it matches my amortization table. But then once they make a payment, they're not going to have the proper breakout between short-term and long-term. So what we want to do after we enter this is put this back over here with a reversing entry so that we once again only have one account per loan, making the bookkeeping as easy as a job as possible, because we have, again, different objectives from the bookkeeping side of things and the adjusting entries side of things. And we're trying to keep the bookkeeper happy over there as well, because that's who the owner has to deal with all the time. The accounting department, if they're not happy, then that's probably, you know, then the owner, whoever the owner is, the stockholder, they're not going to be happy. Anyway, that's it for now.